Hey everyone, how you all doing? Nicole Lerma, Carrie Ellen Wilder, how you doing? Jack Parsons, Polynesian Pip, Aloha, James Richter, Yagi One. First time I've seen you here. Welcome aboard. If you are new, please go ahead, type in new and where you're from, and we'll see if we can go ahead and acknowledge you. So I'll be with you shortly. Let me get a few more things in order, and I'll see you soon. And let me know if the audio is coming in okay for you. See you guys soon. Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. I am your host, Patrick Vieira, and this is our Sunday night live stream for you folks in the U.S. East Coast time, and Monday morning live stream for everyone else over in Asia, over in Singapore. How's everyone doing? Let me take a quick peek at some of the comments here. Bit of a roll call. Again, Helsinki, how are you doing? Bobby Jones, like that name. Chris Primer, who are you and how did I get here? I like that. Hopefully, I'm not going to put anyone in the twilight zone here. Mark Schaefer, how you doing? Patrick Bateman, greetings and salutations. Mr. Nguyen, checking in. How you doing, sir? Fat Vegan, I was watching George Gammon, but then your show came on. All right, thanks for that. Yeah, it's pretty interesting because there is George Gammon, and I think also Wall Street Silver is having one as well. So yeah, everybody seems to be not everybody, but this seems to be a popular time to be having a live stream. So welcome that. I mean, I'm happy that I could get you folks to come here and welcome aboard. Fat Vegan, yep, coffee. It's always good. It's morning here in Asia. James Richter, how you doing? Let's see. No thanks, Webull. Interactive brokers for me. Webull, I think that's the online trading platform, right? If that's what you're referring to. What else is out here? Pablo Pina, how you doing? Always be funding. The MiG 26, how you doing, my friend? TC, greetings from Seattle. Hope everything's okay up there in the Pacific Northwest. Barton Fisk, and let me see. Third world trillionaire. Third world trillionaire. Uh, Very true. Very true. Call of the Wild, Mitch Alex. Okay, so again, thank you all for being here. And as always, if you are new to the channel, please do subscribe, hit that bell to be notified on updates, and give us a thumbs up. We appreciate those thumbs up. They really do help us. YouTube seems to have a liking for kind of holding us down, suppressing us a bit, but we'll continue to march forward and do what we need to do to get the message out to all of you out there, where you can find us on social media. Silverbullion.com.sg is our website. We do sell gold and silver, but we do specialize in systemic wealth protection. A lot of you already know what's going on out there. You see it. Some of you even feel it. And if you're kind of wondering, what you need to do, or if you are wondering what you need to do, go ahead and send us an email, visit our website, and you can go ahead and see what we do to help fight against or protect you against systemic wealth protection. Silver Bullion SG is our Facebook handle. Silver Bullion PL is where you can find us on Twitter. PL for Private Limited. Audio versions, bit.ly, SBTV iTunes, or SBTV Spotify. And as always, if you have that Telegram app on your phone or on your desktop, it is a free app. Do join the Crisis Tracker group, t.me/Crisis Tracker. Here you'll find what Vincent and sometimes myself, we will post things as far as it pertains to gold, silver, economics, finance, things like that. So we kind of go through the weeds for you and pull out the better articles or the more significant articles. So again, do hope you will join that Crisis Tracker group. So once again, hope everyone out there is doing well. Lillian Winston, first time I've seen your name. Welcome aboard. Landshark 7130K, spreading the love. Absolutely, my friend. Jeff 702. Let's see, Jack. Just me. Okay, first time here from Canada. Welcome aboard. Just me. Appreciate you spending the time with us. Let me see a few more things, and we'll go ahead and we'll get started here. So, again, as always, we'll let you know who our upcoming guest is. And I hope I don't butcher his name too much, but our upcoming guest is going to be Rahim Tagizagedan, the director of the Academic Research Institute Scholarium in Vienna, Austria. And in addition to being the foremost Austrian expert on the Austrian School of Economics, Rahim is also a trained physicist and engineer and renowned philosopher. So we're delighted that Rahim will be joining us, and should be interesting. Should be very, very interesting. Looking forward to it. And as always, we will start by our ebook thank you giveaway. Once again, we're going to be giving away Rigged by Stuart Englert. Seems to be a lot of positive response for this book, so we'll continue with it. Stuart Englert, author of Rigged, exposing the largest financial fraud in history. The largest financial fraud in history was not Enron's colossal accounting crimes. It was not Bernie Madoff's record-setting Ponzi scheme or the LIBOR scandal, in which some of the world's biggest banks conspire to profit by manipulating interest rates. Nope. The largest financial fraud in history is one most Americans know little to nothing about, and it isn't mentioned by politicians, reported on the nightly news, or discussed by co-workers during lunch break. And it's not just the U.S., it's probably for most people anywhere in the world. Rules to get this book. Download the Kindle app from your phone or tablet's app store. Again, this is the ebook. Just want to clarify that. Kindle app is free, so go ahead and download it. And be the first to answer correctly in this live stream before the timer runs out. In fact, what we'll do is we'll take the top five. The top five guys who get it, we'll go ahead and give them this book as a prize. The U.S. winners will be given a link to download the ebook. Winners outside the U.S., we're going to have to arrange for some type of alternative prize because Kindle or Amazon doesn't allow Kindle ebooks to be given away as gifts outside of the U.S. So we'll have to figure something out there. And you're going to have to provide us with an email during the live stream. And what will happen is my colleague Vincent is standing by. He will mute your comments so only we can see it. And then you can go ahead and give us your email and all is well. Only we will see it and we'll go ahead and get you that ebook. So having said all that, get ready for the question. You're going to have about a minute and a half. So here we go. The question is going to come from Peter Schiff interview, the recent Peter Schiff interview. Question is, what type of asset does Peter Schiff call Bitcoin and NFTs, non-fungible tokens? He calls them blank, blank assets. It's two words, no profanity. I know what you guys are thinking. 2 words, blank, blank assets. What does Peter Schiff call Bitcoin and NFTs? Okay, so we'll go through it. Let's see what we got here coming up for the answers. Again, what type of asset does Peter Schiff call Bitcoin and NFTs, which are non-fungible tokens? So go ahead and give it a shot. 2 words. Okay, some answers coming in. Non-performing. Just one answer. Let me see what else we got out there. Okay. Fat vegan. Yeah, I knew we were going to get those types of comments, but nope, that's not it. Mitch Alex, greater full. Okay, let me see what else is out there. Truth Monster. Bitcoin is the best money on. Okay. Non-performing Ponzi coin. Vomit. Uh, okay, let me see what else is out there. High risk consumption bubble. Digital dreams. Completely worthless. Great answers. Great answers. Digital fiat. Make believe. Mitch Alex. Greater full assets. Digital token assets. Fake performing. Okay, we're gonna cut it off, and we're gonna cut it off at Mitch Alex. So Mitch Alex. So let me go through this real quick. In fact, the winner and the only one is Mitch Alex. So congratulations, Mitch Alex. Sorry about that. I had my eyes looking at the comments coming in. Mitch Alex is the winner, and just to prove it, here is what Peter Schiff said about Bitcoin and non-fungible tokens as to what type of assets they are.
Bitcoin is nothing. It's a digital token that only has a price, again, because somebody is dumb enough to want to buy it. And why does somebody want to buy it? Because they think somebody in the future will be even dumber and pay an even higher price. Well, none of these greater fool assets can go up indefinitely because there isn't an unlimited supply of fools. There may be a lot of them, but their numbers are not infinite. So at some point, you run out of fools and the market collapses.
Peter Schiff letting us all know that there's not an infinite number of fools. So that's a good thing to know. I've never heard it put that way. So Peter Schiff doing his thing. So let me ask you guys: are Bitcoin and non-fungible tokens are they greater full assets? And again, the way he worded it, that was pretty interesting. So once again, Mitch Alex, my colleague Vincent, he may be contacting you, and he'll go ahead and mute your comments, and then we'll get you that book shortly after the live stream, perhaps. Yeah, a few more comments here. Fantasy Money, Patrick Bateman. Let me see. Okay, not asset, asset. Okay, you guys have some great answers. I wish I could put them all on the live stream, but you never know. Never know. You might have some young people watching, and yeah, we're kind of adults here. So anyway, moving forward, I want to share with you a few more clips from Peter Schiff.
At the end of the day, the dollar has to crash because the only thing that's going to stop the Fed from kicking the can down the road is when it can't do it anymore because the dollar has crashed and made it impossible. Because the Fed can keep printing dollars to buy bonds so long as the dollar has value, so long as the people who are selling those bonds will accept those dollars. But once nobody wants the dollar because they realize it's a bottomless pit and it's going to be printed into oblivion, then that's the real crisis, which is where we're heading, to a U.S. dollar and a U.S. sovereign debt crisis. That's how this thing is going to end up. And of course, that is the worst possible outcome for the United States.
Okay, a dollar crisis. We've all heard this for a while. How and when does it happen? I can't tell you. But I can tell you that we are certainly on that path. And what do we do? What do we do to limit the impact of a dollar crisis? Well, we can limit the amount of dollars we hold and do it by buying stores of wealth, stores of value. In other words, we can turn that paper or dollar into something else like silver, like gold, something that is a store of wealth, a store of value. So here's something else that Peter Schiff said.
You had that Beeble, what is it, 5,000 days, whatever it's called, digital, art sold for $69 million. You have Rob Gronkowski on there auctioning off his digital football cards. I mean, this is completely idiotic. I mean, people are trying to say these things are rare. They're not rare. Who cares? They're nothing. They're digital images. I mean, anybody can have a digital image. There's no real difference between a copy that I can get for free and the one that you're paying hundreds of thousands or millions of dollars to have. Who cares that there's some kind of digital signature that signifies you are the guy dumb enough to actually buy what everybody else can have for free? This is a complete mania. How high it'll go, I have no idea. But in the future, none of these non-fungible tokens are going to be worth anything. So somebody is going to get caught holding a very expensive bag when the music stops.
Okay, well, we've talked about it for some time. This is the new economy. This is the new economy. This is where we're going. We see it with SPAC stocks. Again, we see it with memes, where memes seem to push economies one way or the other. They seem to push Bitcoin one way or the other. They seem to try to, anyway, push things like silver one way or the other. And this is the definition again of the World Economic Forum, this meme economy, or what Peter is talking about with these non fungible tokens. It's almost like the definition again from the World Economic Forum, where they tell us you're going to own nothing and be happy. Because again, with NFTs, what really do you own, right? But it just seems that this is truly the new economy, and I tell you what, I'm still trying to figure out how did we get here? Can anyone tell me how did we reach this point where guys are spending a whole lot of money on a whole lot of nothing? To me, anyway, it seems like I could be wrong. I may start getting some heat from some people, but I'm just saying, uh, for me, I just see it as people are spending a whole lot of money on a whole lot of nothing. So I'm just trying to figure out how do we get here. So if any of you folks can tell me, any of you folks can tell me how we got here, I really really appreciate that. Let me go ahead and flip through these comments here. Let's see. Owen May, it would make sense. Yes, it would make sense if they link this possession of sorts to physical objects. Have absolutely, that would definitely make sense if that were there. Let me see what else is out there now. Silver Warrior and a bunch of you folks, I see it rolling through the comments. Silver getting hammered right now. Time to grow the stack. We'll go ahead and take a look at gold and silver price shortly. Okay, let me see what else is out there. Um, Grow Mechanic. Yes, I see all these apes. Hopefully, some of you apes are out there. I was talking to quite a few of you on Twitter over the weekend. So hopefully, we can all share some knowledge and understand things a bit more. Let me see what else is out there. Okay. Okay. So we look good. Everything looks good there. So let me show you one last clip from the Peter Schiff interview.
There's no question in my mind that over time, more and more vehicles are going to be electric. But I don't think we're going to eliminate the vehicles that run on fossil fuels anytime soon. In fact, I think we're going to continue to manufacture those. And so I think the demand for oil is going to continue to be there for years, if not decades to come. But we will have more demand for electric vehicles as well. And so clearly there's going to be more demand for the raw materials necessary to not only make the cars, but to make the batteries that power them.
Okay, so what Peter was talking about were two metals. He was talking about copper and he was talking about nickel. And nickel is one of the key components in electric vehicle batteries, and he does see a pretty good outlook for nickel. And we do know that nickel had a pretty good run up in price before retreating somewhat. But nonetheless, we can go ahead and move on over to our website, silverbullion.com.sg, and take a look at that gold and silver price. We do sell metals. You can buy and sell with Litecoin, Bitcoin, and Ethereum. And of course, for security purposes, there is two-factor authentication. So let's see what's going on with the silver price. 25.70. Yes, it has come down somewhat. It's come down somewhat. Gold has come down slightly as well. Nickel still above 16,000. It was at 19,000 not that long ago, so it may be a good entry point right now to try and come back in and get some nickel. Again, none of this is financial advice. I'm just sharing with you things that we do and things that we see. So none of this is financial advice, professional or otherwise. Moving down, Silver Bullion Investor Kit. This is a free investor kit. All you need to do is click on it. It'll open up so you can either see it from our website or you can go ahead and you can download it if you prefer to download it. And there are a few topics here that are pretty interesting for people. One of them right here again, investing in electric vehicle battery metals. So nickel does have a pretty good outlook, and we're pretty high on nickel. Bullion genuinity guarantee. We guarantee what we sell. We guarantee what you store with us. We're probably one of the only guys, perhaps, that actually tests the gold and silver that are in the vault. I'm not sure if other vaulting companies actually test the gold and silver that is in there, but we do. So again, this is free. You can either download it or just take a look at it from our website here. Moving down to the gold silver ratio, 67.5. We were at about 65, 66. So it's going back up a bit. Right now, about 67 ounces of silver will be the equivalent of 1 ounce of gold price-wise. Price-wise. Okay, so again, some featured products. We do have nickel, again, which does have a good outlook. And these are always the hot topic, these 1,000 ounce LBMA bars. So you can go ahead and see that we have 308. It's come down somewhat. I think maybe just a couple weeks ago we were over 400. So almost 100 bars have been bought, purchased, and owned and in our vault. And if there's a couple strong guys out there, we have two in the shop where you can come and pick it up. If you do store in the vault, remember to sign up. You will have to sign up with either a personal account, which is just you alone, a joint account, perhaps you and your spouse, a trust account, if you'd like to do that, joint account with a minor. So this is something, another feature that we've added because there was demand for this, where parents wanted to include their children, business account, and a retirement account. So a few various different types of accounts, and all you would need to do is just click on one of them. Just a few bits of information, Mr., Mrs., whatever it may be, doctor, professor, your name, last name, country code for your phone, mobile number, email, because of course we will need to contact you and stay in touch, country of nationality, preferred currency, and all you're really going to need is just to fill out the application and send us a copy of your passport, or for some of you, your driver's license if you're in the States, and that's all you would need for a personal account. And as a reference, how did you find out about us? Please do go ahead and be sure to click YouTube SBTV. This also helps us out quite a bit. So it's a very simple process to do. It's free. There are no maintenance fees, and it's something that I hope you folks do and get ready and have it there waiting for you when you do want to start purchasing some gold and silver and keeping it in a safe jurisdiction such as Singapore. So let me take a quick look at Twitter, see what's going on there. So these are a few things that I bookmarked. One thing from CNBC, coronavirus pandemic may cause a drastic decline in cash usage due to the risk of contamination. So now you're seeing they're actually starting to push this out. I mean, there was a time a lot of us in the beginning, we speculated that this thing would head towards cash, and they would start telling us that the virus is going to contaminate cash. So here you can see it's now starting to come out. Drastic decline in cash usage due to the risk of contamination. Could the bug signal the end of cash in the U.S., and can the U.S. really function without physical currency? So this is coming out from CNBC. It's about 6 minutes long, but if you don't mind, maybe I'll go ahead and play this so we all can see it. It is both sides of the coin. Some people say no, some people say yes. So we'll go ahead and take a look at what this video says.
Cash is king. But in a socially distant world where payment is as easy as... Does cash still hold the same value?
Cash is still relevant, but cash is no longer king. Although people in this country and around the world do continue to use cash to purchase things every day, that is decreasing.
Electronic payments have cannibalized checks. Card payments have grown, but cash has remained king. 2/3 of transactions under $10 are done in cash.
Although data surrounding COVID's impact on cash has yet to be reported, the pandemic is expected to cause a drastic decline in cash usage due to the risk of contamination. The unprecedented surge in the demand for contactless payment has also shown outstanding performances from major companies offering cashless payment methods like Apple, Square, and PayPal.
You're seeing digital payments in this crisis move from being a nice-to-have capability to a must-have essential service.
Whether it is credit or debit or prepaid cards or peer-to-peer services like PayPal or Venmo or others, we're seeing a corresponding increase in digital transactions as we're seeing a decrease in the use of cash.
So could COVID signal the end of cash in the United States? And can the US really function without physical currency? Nearly a third of US adults say they make no purchases using cash during a typical week. The share of people who say that all or almost all of their weekly purchases are made by cash dropped from 24% in 2015 to 18% in 2018. In 2019,
Okay, I'll end it here. It kind of starts to
transact-
slow down, so I'll end it here. But you kind of get the picture. We are starting to head in that space where the fear of the virus being spread through our cash and coin is going to become a narrative where, you know, they are looking to limit or perhaps even eliminate cash and coin. So this is something to keep an eye on. This is nice. I came across it. Wouldn't you folks love to see this? Silver accepted here. This would be a pretty good thing to see. We've seen it with Bitcoin, but hey, it would be pretty good if we could see this with silver as well. So just wanted to share that. It's a pretty nice thing anyway to see. Greg Manarino, he got suspended from LinkedIn and YouTube is censoring his videos. So I guess he's asking them to help out with things. I guess apparently he feels he's getting too close to the target and he's been getting censored a bit. And, you know, we kind of understand that. But again, this is just to say that, you know, there are things nowadays that, you know, whether it be real money or whatever else, it's getting to be a pretty, maybe sensitive might not be the right word, but it is starting to come out more and more where people are starting to understand truth behind money. And I'm glad that you folks here already do understand truth behind money. Again, I was going back and forth with some of the guys from Wall Street Silver. And I had tweeted them, you know, ape tips. They like to be called apes. So don't monkey around. Allocated is not ownership. Read this. So went ahead and found this article that we had on our website where 3 most common storage misunderstandings. Once a systemic crisis occurs and counterparty defaults become common, your preparedness in these matters will make all the difference to your wealth. And this is from Gregor Gregerson, the founder of Silver Bullion and the Safe House. And this is something that the apes and I were talking about. Fully allocated is not ownership. Remember, allocated simply means that there's a pile of gold or a pile of silver sitting there that you have a claim to. Okay, you have a claim to it, but what specific bar or what specific coin do you own? Now, that's a totally different story. It's like if you buy real estate, you have an address that pertains to a certain lot. Okay, so you know that lot, that house is yours, and that address verifies that for you. In allocated, there may be nothing to verify that a specific coin or bar is yours. So our financial system is based on IOUs, whereby one party owes something to another party and is therefore dependent on their counterparty solvency. Most bullion storage systems, whether allocated, unallocated, or unbacked, are also IOU based. Okay, they're also IOU based. And in these systems, bullion ounces are owed to, but not owned by the customer. Hence, customers are relegated to creditor status, and it's possible for the dealer to then utilize stored bullion as inventory to sell to new customers. And it is possible for them, these bullion dealers, to lease out their own bullion to third parties for additional income. And we routinely see evidence of such a system when a customer's transfer to us, when they transfer to us from an IOU-based storage system. On many occasions, bullion coins that a customer bought in, say, 2012 would arrive at our vault as 2015 minted coins. So I'll leave you to figure out, how does that happen? How do you buy 2012 coins, put them in storage with your bullion dealer, and when you want to take them out, withdraw and transfer them out, you get 2015 coins? I mean, maybe it's nice you got new coins, but you were paying storage fees during all that time for 2012 coins. So you were paying storage fees for 3 years, and you had a different set of coins come out when you decided to take them out. And so this is one of the things with allocated, because you do not have a specific bar, a specific coin. You can get anything. Whereas for us, as many of you folks know, we put things in tamper evident parcels, give it a unique serial number that goes to you, and it's yours. You own it. You own it. Okay, so it's a very different system that we run here. Okay, so going forward, another past guest, of course, we had Gerald Taleni, and I want to go over a few things from his most recent Trends Journal. He always puts out a great weekly publication. Janet Yellen gives a boost. Almost $2 trillion will be given to the bug-destroyed economy. Yellen quoted as saying on ABC's This Week, policymaking is about identifying and addressing risks, and the most significant risk we face is a workforce that's scarred by a long period of unemployment. And she also says price spikes in gasoline and other things are just a temporary movement in prices. Let's just call it inflation. And because the CPI does not count food and energy, the Fed is still seeing inflation as something that's still fairly low right now, but the rest of us know otherwise. Commodity quicks, Brent crude spiked some 86% since Q4 last year. Lumber is up almost 200% since April of 2020. The copper up 67% in the past year. Gold still trading in the low 1700 range. Silver trading in the high 25, low 26 level. And in general, as oil goes, prices across the board goes. So if oil goes up, you can look at prices across the board, more than likely going up as well. Unemployment, new unemployment claims for benefits over 700,000, still slightly down a bit though. The employers added some 379,000 jobs in Feb, but the weekly claims are still higher than those of the Great Depression, just to put this in context. And more than 20 million are receiving federal and state jobless payments. And taking a look at the work sectors, food, travel, and events still taking a hit. From the 20.5 million unemployed, the greatest sector is food, travel, and events. The second is services. Those two combined, they're over 50%. Over half of the unemployed come from food, travel, and events, as well as services. Retail also taking a bit of a hit as we see more and more online purchases happening. Medical providers, education, these people, they're still at work. We need the medical people and education. Of course, teachers have improvised and gone online. And others at 20%, perhaps this may be gig economy and things like that. So in going over these things, I came also across something from another former guest, Tavi Costa and Kevin Smith from Crescat Capital, and something they recently put out. And I wanted to push it out still, because I think what they put together was some pretty great information, and I wanted to share it with you. So all credit, of course, to Tavi Costa, Kevin Smith, and Crescat Capital. And I'll start with there are a few clips that we'll go through. So let me see what else is out there. I think we can start here.
The Fed purchases of treasuries, and it's incredible. From February 24th to March 4th, I believe, NASDAQ was down about 10.5% or so. S&P down 4%. S&P equal weighted down 3.3%. And the Fed is forced to come in and do its largest buying spree of treasuries on a monthly basis or trailing 4-week basis since June 2020. You can't make this stuff up. $95 billion in 4 weeks. And 90% of what they're doing actually recently, I mean, they started really buying a lot of tips at the very beginning of the pandemic, and now they're buying longer duration bonds. Most of it is now, in the 5-year, I would say 5-year range, but still they're increasing their pace in the longer term or longer duration bonds. So yield curve control is certainly already in play, and even though we have not heard officially from them, that is certainly in action.
Okay, so Fed buying treasuries. We know the Fed is very, very active in the market, and we'll take a look at a few things that Jerome Powell said a bit later on. And the Fed has bought $95 billion in treasuries in 4 weeks. Okay, in 4 weeks, $95 billion. Buying longer duration bonds. Before they were just buying the short end. Now they are buying longer duration bonds. Increasing price in longer duration bonds. Yield curve control is certainly already in play, even though we have not heard it officially from them. So the Fed has yet to say that they've implemented yield curve control. They have yet to say that they are operating Operation Twist again. So the Fed, they have yet to say these things. Is yield curve control already happening? Price discovery and every element of the markets are being distorted. We all know that. It's like the keel broke off a boat and there's no direction. And when that happens, I can imagine you have at least two choices. You do your best to stay on point and focus on your compass, or you drop anchor. And in this case, markets that are out of control means our compass and our anchor in this central bank's created storm means seek safety in things like precious metals, seek safety in things like silver and gold. Moving on.
Just looking at used car prices at all-time highs. We've had CPI numbers came out, and CPI's number came out at about 1.7%, which I find it a joke. It's a completely lie about what's really happening here in terms of, you look at almost any metric of a good or service in the whole country, and everything is up at least 10% on a year-over-year basis. Obviously, this is a number for February, where we're going to be seeing the largest impact will be in March. But still, even their used car prices on a year-over-year basis that they used is way off from what we're actually seeing in this index, for instance. And what is really driving this in this case in used car prices is not really aggregate demand. And I'm using this just as an example of other things that we're seeing. It's a supply constraint impacting production of new cars that is forcing people to buy used cars. And, I find this, this is happening across a lot of other goods and services, because of the pandemic problems that we're seeing. And again, it goes back to the 1919 Spanish flu problems that we saw and how those really impacted the economy at the time. And we saw inflationary forces picking up. And it's a serious question for all investors today. And I see a lot of people in the deflation camp still, and which there are valid points in the deflationary thesis as well, given the overvaluation of assets. And so the reckoning should certainly be somewhat deflationary. But first, what we're seeing in terms of the liquidity in the markets, this MMT, in full force, the stimulus checks that are here to stay, commodities on fire. The stocks cannot even correct a few percentage points, and the Federal Reserve has to pick up its stimulus pace already. So, how is this not going to lead to inflation, I ask? And it's way too much money slushing around, in my view.
Okay, so again, pretty interesting what he had to say there. Used car prices are at all-time highs. CPI at 1.7 is a joke, complete lie, as he says. Almost any metric on goods and services are up at least 10% on a year-over-year basis. Supply constraint in new cars are forcing people to buy used cars. MMT in full force. Stimulus checks are here to stay. That's a pretty profound statement. Stimulus checks are here to stay. Stocks are not even allowed to correct a few points. I think we all see this. And how is this not going to lead to inflation? And Tommy makes a great point where demand for cars has found its way into the used car market. Again, inflation is when too much money sloshing around chases after a few products and services. And in this case, it's very relevant as well in the housing market, which I will touch on. But first, I saw a comment that I think we should address because I think maybe you folks have seen this as well. This coming in from the Little Muddy Farm, Robert Jones. Here, USA Mint is canceling orders. Anyone else see that on Twitter? Okay, I've seen this on Twitter as well. And there's a photo that goes with it, right? But what I'm seeing when I look at that photo is perhaps it could be just someone like you or me if we bought a series coin, a limited edition coin or something like that, and they no longer make that coin, and so they had to cancel that coin. I'm seeing it as that basically. I'm not seeing it unless something else comes out. I'm not seeing it as, it's one of their authorized dealers who have or who are getting their orders canceled, because that's an entirely different animal than if you and I were just trying to purchase some type of limited edition coin or a special series coin. So for me, when I looked at that, I seen it as this is just one of those limited edition or special series. I didn't see it as, this was meant to an authorized dealer where their large order of monster boxes are canceled. I didn't see it that way. So again, unless something else is out there, I would just read it as this is probably just a regular average Joe buying a special edition coin. So I did see that. Anyway, nonetheless, let's move forward. Okay, so we did talk about housing. So let me go through something on housing, and we did see this big, huge upturn on lumber prices. So let's take a look here and see what's going on. Okay, the U.S. faces a housing shortage. Will 2020 be a turning point? So this is from Forbes, and this is back in January, so fairly recent still. The housing market has been struggling to keep up with demand since the 2010s. Remember 2010 now, right? Just coming off of the Great Reset, coming off the housing market crash, and Fed starting QE. So it's been struggling since 2010 when the number of new homes was built and slashed in half compared with the previous decade. As the demand for residential real estate has increased, the scarcity of homes for sale has created a log jam on the supply side. And millennials, who make up approximately 38% of the home buyer share, are getting married and they're having children. And in effect, looking for a home, either their first or second. With so many motivated buyers in the market, you end up with multiple people bidding on the same house, which triggers price increases. Affordability issues then naturally rise. Again, a lot of money sloshing around, too few products that it goes after. It's going to raise the price. Inflation. So here's the look at what experts. Well, I think we can end it there. The problem is there aren't enough houses. We'll end it there, but we will come back to this. So let's see what else Tavi Costa had to say.
The Fed's holdings of mortgage-backed securities, rates are up, about 40 bips or so in the 10-year rates in the last month or so, a few, this period recently. And the Fed was forced to buy $110 billion worth of mortgage-backed securities in 2 weeks. It's the largest increase in this since May of 2020. And the Fed is as strapped as it can be. And this whole thing is a house of cards. It really is. I mean, it's, mortgage rates are not even allowed to rise at the current pace at 10-year yields, and 30-year yields have been rising. Otherwise, who's holding the back on the housing market? Well, it's the bottom 50%. They hold a large percentage of their assets is in the housing market. It goes against even inequality problems to allow the housing market to collapse. So, it creates this dependency of further monetary policy And I ask again, how in the world are we not going to see inflation?
Okay, so Fed holdings of mortgage-backed securities, Fed forced to buy $110 billion of mortgage-backed securities in 2 weeks. In 2 weeks, largest increase since May of 2020, and the Fed is strapped. It's a house of cards. The bottom 50% are holding the housing market. The bottom 50% are holding the housing market. Guys, we've seen this before. And there is further dependency on monetary policy. So we basically the Fed and the government, they haven't quite figured out that when you find yourself in a hole, you put the shovel down and you stop digging. But they continue to dig, and in fact they've put that shovel down only to call for an excavator to dig even faster and even deeper. Okay, so moving on. And because rates have been so low for so long, a lot of people have bought a second home, as that article even just showed, and even third homes. And people have bought more homes than they needed with the monetary dreams of renting it out, having companies like Airbnb find travelers to stay in their homes. And in part, as a result, home prices are going through the roof. How bad is it? Let me show you this clip from my home state of Hawaii, and try and wrap your head around this. This is how bad it's getting.
It is a lesson in supply and demand. Hawaii's real estate market at an all-time high. Again, how many times have we heard that? Homes, condos selling fast, even with the uncertainty caused by the pandemic. Nikki Schenfeld tonight speaking with realtors who weigh in on what the future might have in store.
The pandemic has surprised many realtors statewide.
This is my third upcycle, but I've never seen a market like this.
Low interest rates and no limits on VA loans means more buyers, but there's little inventory available.
And we have sort of the perfect storm. So we are finding that we are begging people to put properties on the market because we have tons of buyers that are just looking for a place to live.
She says 80 to 90% of home buyers on Oahu are residents. The majority are second-time buyers taking advantage of low rates and looking for something bigger because they may be working from home.
So our prices in single-family homes just took off. Eva and Kapolei have really taken off.
The current median price for a single-family home on Oahu is $883,000, well above the affordability index for many residents. For those who can afford it, she says, be ready to go. Houses are averaging about 9 days on the market.
They're competing between 15, I've heard upwards in 28 offers per house. My philosophy is you will get the one you are meant to have. So you just keep going and putting in offers.
It's been harder for Maui residents to get their foot in the door too. The median price for a single family home on the Valley Isle is a whopping $950,000.
The market's so fluid. I get a guy that says, hey, I want $900,000 for my house. I'm kind of like, you just might get it. It's sad. It's not fair, to the kids here or just even adults.
On Maui, about 30% of sales have been mainland buyers. He says many are former residents finally able to move home, but they're also seeing an uptick in millennial buyers.
And you got these millennials in California that have been doing these big jobs, and they got $2 million, and let's just buy this house.
He says lack of high-paying jobs and affordable housing are also pushing local buyers out.
What goes up, it's got to go down,
Analysts expect this trend to continue for a while, but warn that the bubble could burst and cause a spike in foreclosures in about 2 to 3 years. For now, he says buyers should anticipate paying full price or more than asking. He advises new buyers to consider smaller condos and work towards your dream home. Nikki Schenfeld, KHON2 News.
Okay, so how about that? 880,000, 900,000. I wonder if I'm ever going to be able to go home. Prices are crazy, and I've seen some comments. Some people, they blame the boomers for it. Well, as this gentleman said, a lot of it are millennials as well. So let's not generalize as to who is doing what to the markets, because the truth of the matter is it's the Fed and the money printing and the government who are allowing all of these things to happen. All right, moving forward. some more from Crescat Capital.
We don't want people to be fooled by what we call the fake rotation, and that's a rotation into perceived value cyclicals, whether it's retail stocks or airlines or whatnot, that really have terrible balance sheets and terrible fundamentals and terrible valuations. Even in this market today, with all the money printing and all of the stimulus, we didn't get a real recession. I mean, yeah, we've been in a COVID-led recession, but it hasn't been your typical recession where you have stock market bubbles bursting. We had a mini burst in March, but everything is reflated again and back up near all-time highs. But what is all this new modern monetary theory going to do when it comes to combined fiscal stimulus and monetary stimulus at the same time? It's going to cause a rotation out of record overvalued stocks at large, especially overvalued mega cap tech stocks and large cap growth stocks, and out of record low interest rate fixed income products and into undervalued commodities. And now there's two other major commodity cycle setups that we've had that are very similar to where we are today. We've talked about this before, so I'll just show it here again real quick. One of them is that 1972 Nifty 50 bubble. The other one is the 2000 tech bubble. As you can see, the setup is very similar here today. Wonderful setup for rotation out of stocks and into commodities. So what's first and foremost the commodity that we want to own, given these record deficits, unlike, very much like World War II kind of deficits, except we're not in World War II. We are in a post-COVID recovery situation.
Okay, the fake rotation is what Kevin Smith calls it. Kevin Smith from Crescat Capital. I like that term. It's a pretty interesting term. Rotation in perceived value, cyclicals, retail stocks, airlines, things like that. This is not a typical recession where bubbles burst. In this recession, what we are seeing is bubbles continuing to inflate. So it's a very, very strange dynamic, the fake rotation. Everything is reflated again, all-time highs. I just showed you, cost of lumber, cost of homes, and everything again is reaching or reflated again, and the markets are reaching all-time highs. MMT and stimulus combined with a rotation out of record overvalued stocks at large and into undervalued commodities. So again, this more than likely is what's going to happen, where you're going to see this rotation and they're going to come into real things like commodities, which are things like gold and silver. The rotation is pretty much set up similar to the 1972 Nifty 50 bubble and the 2000 tech bubble. And it's like World War II deficits, except we're not in World War II. We're just in a post-bug recovery situation. And, it's amazing what's going on right now. The fake rotation, eventually people will rotate out of the fake market, the fake economy. They realize the bubbles they are in and will seek shelter before these bubbles pop. Why are we in bubbles? It's not because of boomers. We are in bubbles because of Fed intervention. Let's recall Fed market intervention goes back to at least 2008, when the market was just at some 7,000 points or so. And now here we are later with nonstop Fed intervention, and the markets are at over 30,000. Over 30,000. So you got to wonder if this thing really pops and goes back to where it's supposed to be. Will it go all the way back to 7,000? That would be pretty disastrous for quite a few people. A few more clips from Tavi and Kevin over at Crescat.
First and foremost, we want to be in precious metals as the primary commodity that's going to be a beneficiary of new money printing, with the Fed, the lender of last resort, coming in to buy this massive treasury supply that is coming on. They are the marginal lender buyer of last resort for the treasuries. What does that mean? It means there's more money printing coming. What does money printing do? Money printing is the first and foremost biggest driver long-term of the price of gold. Based upon the top 8 central banks' money printing to date, their central bank assets. We have a target price for gold today of $3,200 an ounce. That target price is only rising as more money printing will be coming on, including from the Fed.
Okay, central bank assets in gold. First and foremost, we want to be in precious metals. A lot of us are. We already see what's happening. And again, as I always often say, this is why your comments are important, because there are new guys that are coming in, whether they're apes from Wall Street Silver, whether they are boomers, as some people like to say, but all across the board, young people, millennials, middle-aged, older people, people headed towards retirement, trying to figure out what they can do with their money to keep the value of their money. So we're seeing more and more people want to be in precious metals. Beneficiary of new money printing, the Fed is the buyer and lender of last resort. They have become that buyer and lender of last resort. They print it and they buy it, then they'll print more and they will buy it. They're going to, how can you not say they're going to own everything at some point, correct? Money printing is a driver of the price of gold based on central bank actions, also the gold price. What they're looking at is a 3,200 ounce target, perhaps even rising. So this is coming from Kevin Smith over at Crescat Capital. And kindly allow me to just say this. The price of physical gold and silver does not mean all that much when you look at them to be stores of wealth, stores of value. Store of wealth means it's meant to hold your wealth in an item outside of fiat, outside of currency, perhaps sometimes even out of the current monetary system. And I want to just bring in a comment from Carrie Ellen Welder. So I hope I don't lose my place here where I'm at. So I want to bring in a comment. The Fed is creating monetary distortions and perversions of every type. Law of unintended consequences has also taken over. Nightmare for many is opportunity for a few clever ones. That's a clever answer. That's a really great comment there. I think what we'll do, Vincent, if possible, let's get her email address and send her out a book also, Rig Stuart Englert's book. So Carrie Ellen Vincent should be contacting you, and we'll go ahead and send you that ebook as well. And she makes a great point. This is what we've been talking about. The Fed intervention has been going on for so long. It's even unchecked already at this point. But at some point, there are going to be consequences, and I think a lot of them are going to be unintended consequences. So again, that's a great point from Carrie Ellen. Okay, continuing on. Should currencies get in trouble, which is expected, or banks get in trouble, which is also expected, the value in monetary terms or wealth that went into gold and silver will hold it, and your wealth will be able to return out of it. And this is the insurance aspect of gold and silver. Not to forget the investment portion of gold and silver. It's an insurance and an investment. So while gold and silver are insuring you or acting as a hedge against what the Fed is doing against inflation, it's also going to act as an investment where you're going to see that value of gold and silver go up. So not only is it storing your wealth, it's also an investment that more than likely is going to rise. So moving on, Crescat Capital, 2 more clips.
So what is the other primary driver that goes hand in hand with this money printing? It's rising inflation expectations, which translate into negative real interest rates. Now, this is looking at real interest rates inverted based on 5-year tips. What does it show? It shows that already we, based upon on the inflation expectations embedded into the CPI, we are inflation expectations are rising. Interest rates are negative and getting more negative. That is the trend. Normally, this is a very big driver for the price of gold in the short run. And look what we have here. Instead, we have this major pullback in gold. But folks, I'm going to tell you that inflation expectations are only going to be continuing to rise. That blue line's only going to keep going up, folks, and that's what's going to be driving the price of gold up here in the very short term.
Okay, gold and real interest rates. Inflation expectations are rising. We all know this. We all see this. It's easily provable time and time over and over again. Interest rates are negative and getting more negative. This is the trend. Driver for the price of gold and it's a driver for the price of gold in the very short term. Excuse me. And again, gold and silver, stores of value. They are an inflation hedge. As inflation becomes more and more apparent, more investors and average Joes, they're going to head into silver and gold. So one more clip from Crescat Capital, and I know you folks already know this, so congratulations to you. One more clip from Crescat Capital.
CPI is a bogus indicator of inflation, and it's a bogus indicator embedded into the tips curve as to what inflation expectations really are. So what are really inflation expectations? Well, one source we can go to look at that is the University of Michigan study, and they're about a full 100 basis points or a full percentage point higher than what the inflation expectations embedded in the tips curve are. I mean, even more than 100 basis points, I think now. So this, this is the real world, folks. We all know the prices are rising much more than what our government tells us that the CPI is. I mean, and this is why we're going to have this reflexive, self-reinforcing great rotation out of overvalued stocks and fixed income products. And because people are going to be looking for inflation protection. And where do you go for that? First and foremost, it's the precious metals markets.
Okay, so long-term inflation expectations, CPI is a bogus indicator of inflation. And again, we know why, because it does not take into account energy and food, which are two things that you and I use every day. If you are concerned about energy and if you are concerned about oil and gas, we have a comment from Tony. Here's his suggestion. Just drive downhill. Just drive downhill and you'll save a bit on your inflating gas prices. Okay, but getting back to it, University of Michigan survey shows inflation is higher than being reported. People will be looking for inflation protection, and they, meaning you and me, we're going to be going into the precious metals markets. We're here already, and we're seeing more and more people going into it. It's not just that, there's a movement going on right now with silver that seems to be emptying the shelves of quite a lot of dealers. It's more about people waking up to what money is, and people waking up to how our government took money away from us once they removed the gold, once they removed the silver. And I keep saying this, if people want a $15 an hour minimum wage, you need to be going after your politicians to put silver and gold back in the money. Because if silver and gold were still in the money, your $1.50 face value would be worth a little bit over $26 today, had that silver content stayed in. So $1.50 of your silver, of your coins anyway, back in 1964 and earlier, is worth $26, $27 today. So there's your $15 minimum wage. It was taken away from you when government removed gold and silver from money. And a lot of us, we already know this, and this is why we do what we do. Let me continue on here. So Tavi and his team at Crescat Capital, they put out some incredibly valuable numbers for us, and we appreciate that. All credit to them, and I'd like to encourage you to go and visit their website, www.crescat.net. So Tavi, Kevin, and the gang at Crescat Capital, all information, all of that belongs to you. We're just sharing it in some ways, but all of it is your content. So we just want to make that clear. Okay, and yes, Jerome Powell did speak last week at the FOMC meeting, so we're going to take a look at a few things that Jerome Powell said. Buckle up, guys.
Here at the Federal Reserve, we rapidly deployed our full range of tools to provide relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. We are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. The economic fallout has been real and widespread. But with the benefit of perspective, we can say that some of the very worst economic outcomes have been avoided by swift and forceful action from Congress, from across government, and in cities and towns across the country. More people held on to their jobs, more businesses kept their doors open, and more incomes were saved as a result of these swift and forceful policy actions. And while we welcome these positive developments, no one should be complacent. At the Fed, we will continue to provide the economy the support that it needs for as long as it takes.
Yeah, there's that cough again. I wanted to bring in that John Coffee Green Mile clip, but maybe some other time. So Jerome and his Green Mile, John Coffee Cough, says the Fed rapidly deployed tools to provide relief and stability. Rapidly deployed tools, I guess that means they turned up the knob on the printing press. Intends to limit lasting damage to the economy. Opposite is happening. Unintended consequences, as Carrie Ellen said. Working for maximum employment and price stability. That is their mandate. Are they staying within their mandate? It's debatable. For me, it's they've really gone out of their mandate already. Economic fallout real and widespread. We see it. Fed's swift actions kept businesses open, people employed, incomes saved. That's debatable. Sometimes you got to wonder, is this a show to really help people, let them know what's going on, or is it something where don't come after us because we're doing this for you to help you, so it's not our fault. And they will continue to give the economy the support it needs for as long as it takes. And again, when I break down the Fed speak, it really looks like, hey, we printed all this money and we'll continue to print all this money. And we gave you all this money and you all should be grateful. Bigger picture, and what he's saying may very well be the setup for inflation, deflecting the blame on the Fed and on our politicians to where we see them as helping us instead of being the ones that actually cause the problems and are hurting us. So 2 more clips from Jerome Powell.
Today, the FOMC kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread. Since January, the number of new cases, hospitalizations, and deaths has fallen, and ongoing vaccinations offer hope for a return to more normal conditions later this year. In the meantime, continued observance of social distancing measures and wearing masks will help us reach that goal as soon as possible.
Okay, and if you notice, he's no longer wearing purple ties. It's all blue. Anyway, Jay says interest rates will remain near zero, will remain sizable, or will continue with sizable asset purchases. Monetary policy will support the economy until the recovery is complete. What is the definition of complete? The path of economy depends on the course of the virus, and since January, cases, hospitalizations, and deaths have fallen. And vaccinations offer hope to normalizing things this year. Continue to wear your mask and practice social distancing is what Jay says. So the Fed will not raise rates and will continue to buy up treasuries and mortgage-backed securities. And he speaks about monetary policy continuing until the recovery is complete. But again, what is complete? What is the definition? What's the definition of complete? If the Fed had a target, a definition of complete, this was his chance to tell us. This was his chance to tell us what he means. Instead, what he told us is that either the Fed has no plan, which I doubt. They have a plan. Or the Fed has a plan that they simply do not want to tell us. And it's more than likely it's that. Now, knowing the Fed and the Treasury, which is the government, are in lockstep with Fed heads, Yellen and Powell, my money is they do have a plan, a path that they are moving us, meaning you and me, onto. Will it involve central bank digital currencies? Of course. Will it involve going cashless? Eventually. Will it involve a new monetary system? Absolutely. And understand this is their plan. They've already told us. I'm not saying anything new. However, this is their plan. Is it yours? Is it mine? Is it what we want? Last clip from Jerome Powell.
The economic recovery remains uneven and far from complete, and the path ahead remains uncertain. Following the moderation in the pace of the recovery that began toward the end of last year, indicators of economic activity and employment have turned up recently, although the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing remain weak. Household spending on goods has risen notably so far this year. In contrast, household spending on services remains low, especially in services that typically require people to gather closely, including travel and hospitality. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due importantly to unprecedented fiscal and monetary policy actions, which have provided essential support to households, businesses, and communities.
Okay, so economic recovery remains uneven. Indicators have turned up. Household spending on goods have risen, notably, but not on services. And we saw that in the chart earlier. The housing sector more than fully recovered. Fiscal and monetary policies of support should be praised. What is uneven? Again, another curious word that he chooses. Are we looking at universal basic income, UBI? Is that what he means when he says uneven and how things need to even out? Make things even with UBI? Household spending is up. Are we talking on volume or on price? Are people spending more, meaning volume? Or are they perhaps buying a little bit less, but those less things are starting to cost more? So what does it mean? Kind of means inflation, I guess, if you look at it that way. The housing sector fully recovered, meaning inflated home prices, unlimited home supply paired with low interest rates, causing more people to take out a loan and more dollars chasing fewer homes. It's inflation, Jay. Inflation is really starting to show. And yes, we must all be thankful to the government and to the Federal Reserve, who have since 2006 perpetually inflated the markets. Again, deflecting blame and expecting praise and thanks is what it seems like. The Fed narrative has to be, we helped you, we did not hurt you. And so that's our look at what Jay Powell said. I'll just touch on a few things later. A bit of sarcasm in there, but I think it's because a lot of us here, we already know what's going on. We're woke. We are awake, I should say, to what's going on. We already understand how we need to do things to protect ourselves. We need to do simple things like buy gold and silver, which are stores of value, stores of wealth. Again, it's not financial advice, professional or otherwise. It's just sharing what we do. And a lot of you folks already out there do it. And it's a great thing because, as I always say, we got to be a blessing and not a burden. I think you folks can already see there's going to be a lot of, on one half, trouble coming down the road, but on the other half, there's going to be a lot of opportunities. So again, all this is not bad news. If you are doing the right things right now, when these opportunities come, you are going to set yourself up and generations to be on the right side of this trade of what's happening right now. So a little bit of commentary here. Overall, the Fed does not see lift off until 2023. For another 2 years, the Fed is not going to raise rates unless something unforeseen comes about. Crescat Capital's numbers, though, are telling us a different story than that of what the Fed is telling us. Inflation is here. Yield curve control, Operation Twist, unlimited buying and selling. The Fed is only telling us some of the story, and you and I, we can't wait. We cannot wait for the Fed or the governments or politicians to tell us the other half of the story. We can't wait. And remember, the Great Recession in 2007, 2008, it's documented. It is documented how the whole global financial system was going to fail in 2 days. This is what they came out and said afterwards, okay? Did they come out and tell us this at that time when things were going on? Did they come out and tell us, hey guys, look, I think in 2 days, everything's going to fall apart? No, they didn't. They kept quiet about it, and it wasn't until they solved things. Then they came out and told us things would have went really, really bad in 2 more days. So the thing is, they're not going to tell us. Should this time be any different, they're still not going to tell us. Will the government and the Fed warn us of how bad things are? No, they won't. And we know their history. Like I said, we know what they did in 2007, 2008. We're on our own. We are on our own. So again, your comments definitely mean a lot to guys who are watching, who are trying to understand what's going on. So appreciate these comments as they come in. Let me just take a look to see if I can pull some of them up. David Bagley, the debt bubble collapse is unstoppable. I'd have to agree. The way things are going right now, definitely have to agree. And speaking of debt bubble, I understand Joe Biden just canceled $1 billion worth of student loans. Did any of you guys see that? Let me see if I can pull this up here. Hang on. Let me see if I can pull this up real quick for you guys. Just give me a second here. Okay, hang on. So I'll see if I can pull this up. Okay, so student loan cancellation. America reacts to $1 billion of student loan cancellation. This is coming from Forbes. Let me see here. March 20th, 2021, 8 a.m. Eastern time. So it's pretty new. President Joe Biden, just canceled $1 billion of student loans. And this is how America reacted. Student loan cancellation is here, and the U.S. Department of Education just canceled $1 billion of student loans for 72,000 student loan borrowers. These student loan borrowers previously had some student loans canceled, but now will get full student loan cancellation if they attend a school that engaged in deceptive or illegal practices or closed suddenly. So basically that's the gist of it, and I guess there's more to it. So I think we're on the road to full cancellation, and no doubt this will be used as it'll be pandered to voters in the future. Always be funding, correct. It is, and it's from the student loans from bankrupt and for-profit colleges. So okay, I did, and it's the student loans from correct. So it did say that it did mention that in the article there, but he is starting to it's the first step. It's the first step. I fully believe they're going to continue on. They're going to continue on, and you're going to see this come up as a political tool. You're going to see this as something that will be pandered for votes. Not taking any sides here, just saying that this is how the government works today. This is how it works. So anyway, let me take a look at a few comments here, and we'll close up shop. A few more comments. Let me see. Okay, let's see. Let me go through comments here. Okay. Hope that didn't cause too much heat. Too much heat there. I see a lot of people getting pretty active, typing in all caps. So let's see. Bacon gravy, highway robbery of those who did pay their debts. That is true. But for now, anyway, this is really regarding universities, colleges who did some unscrupulous types of things or shut down. They became fly-by-night universities. But this is what happens when government gets involved. these universities, they saw that it's no longer about, does someone actually, can they get into a university? They eased up all of these things, and, they knew that it was guaranteed money. The colleges and universities knew it was guaranteed money. The government was going to pay for it. So, hey, raise salaries, raise tuitions, and government's going to pay for it. But then eventually it's going to roll back downhill back to the student. And a lot of students were stuck. And it was something that I even asked Peter Schiff, regarding student debt. I understand they have a responsibility, but as our younger people, these are the people that are eventually going to lead, that are going to eventually be in Congress. These are the future entrepreneurs, and having this, big debt burden. How do they find work to pay it when the market is tight? How do they become entrepreneurs, which can create new businesses if they have, such a debt burden to pay off? So that's what I had meant when I asked Peter Schiff about, is there, on the flip side, something or a good thing about canceling student loans where it frees up the young people to be the investment for the country that they were meant to be? But there's a lot of mixed feelings on that. So, fair enough on both sides. There's fair enough on both sides. Okay, so let me see what else is out there. Stack gold and silver first to protect wealth. Okay, that's important. Even Kevin Smith, they were saying this, not an investment. Okay, crazier things happen every day. That said, the investment benefit comes too. Okay, it does come too, and it'll come a bit later because precious metals are so undervalued right now. So again, understand the two components. I mean, there's more than two components, but when you decide to go into gold and silver, understand it's probably one of the few things that are an investment and an insurance. And sometimes they act in unison, and sometimes they are in a bit of a tug of war. But one side will always shine. Either the investment side will shine, or the insurance side will shine. Eventually, we're going to get to a point where both sides are going to shine. I can say that with certainty. It's going to happen. So, having said that, let me just look for perhaps one more comment, and then we'll close it up here. Let me just scroll through it. Let's see. Okay. I don't know why people study nowadays, as there doesn't seem to be jobs available in their field when they graduate. All that debt for what? And, it is a point. That is a good point that you made, considering, again, we are heading into a new economy. Perhaps some of those degrees that they got may not be very useful in the new economy. So it is, it is something that's going to be ongoing. It's something that the government is going to have to figure out. But again, government should not have ever gotten involved. As Peter Schiff said, this was something that the private sector should have been allowed to take care of. So anyway, having said all this, I do appreciate each and every one of you being here. Again, be a blessing, not a burden. We all know what's coming. We don't know when. So that allows us the opportunity to saddle up and silver up. And having said that, I will see you folks next week. Take care, and just be sure to keep stacking. Take care.